Okay. Good morning, dear friends. Uh, we have already shared the material for today's session. Please download from the life.ici.org Board of Studies. The link is mentioned on the board. And today we are having a new standard that we will be covering today as well as on Monday that deals with income taxes, Ind AS 12. Before I forget, let me tell you that the problems that we discussed in Ind AS 102, as well as the problems that I had given you for homework, all those problems I have it has been uploaded on this website. The Excel files have been uploaded, so you can please download and refer the solutions for your understanding. I have also uploaded the Ind AS 102 revised presentation, which of course contains all the problems that we discussed, but it also contains the theory part that I have covered, as well as other items which are mentioned in the standard. So it is a complete presentation in, of course, a small brief synopsis form. So I request you to please download that material as well, and that will certainly help you for your understanding of the theory, and the problems connected to each part of theory are mentioned at the respective places. So I request you to please download that theory as well for your understanding. So that was a brief what I had to say announcement relating to your material. Get this presentation on Ind AS 12 also, and we shall now commence discussion on Ind AS 12 that deals with income taxes. All right. Now, this topic, that is Ind AS 12, is a technical standard. I will not call it a difficult one, but it is slightly technical in the sense that there are many concepts that we need to understand. There are many scenarios that are given. There are many examples that are there. So I will be taking you through the examples that are mentioned in the study module, as I have been doing. I will try to cover some questions from the RTPs as well, because the RTPs have given some very good questions on this standard. It is noticeable that this standard has not been asked in the last 3 attempts in your examination, although certain application aspects of these standards of this standard has been asked, but it is just an ancillary part of a main question pertaining to other standards. On a standalone basis, this standard has not been examined. So therefore, this standard acquires more importance in that regard. All right. So therefore, your attention for this standard is very much required. And not only the attention, I would also like if you would open the study module and keep it with yourself for reference. So particularly when we are doing the examples that are given. Okay. So now let us come to this standard, income taxes. All right. So what was the need for this standard? What does this standard seek to address? That is what we have to understand. Now, when we talk about income taxes, the first thing that comes to our mind is the Income Tax Act 1961. But let us understand the genesis of Ind AS 12, the source of Ind AS 12. Ind AS 12 comes from the IASB standard IAS 12, that is the IFRS is the IAS 12. And we have a converged approach. So we have drawn the standards from Ind AS, from IAS 12. We are now having Ind AS 12 accordingly. So let us remember that the IAS 12 has given certain guidances in its standard. It is not particularly referring to any statute. It is not particularly referring to any country's income tax act. So therefore, when we do this standard, that is Ind AS 12, all of us do know Income Tax Act 1961, at least the working level knowledge is available to us. So therefore, you may find certain problems where there are certain tax adjustments which are not given in the Income Tax Act 1961. So I request you, when you are approaching this standard, let us understand this standard in isolation. Let us not get confused by the word that income tax only refers to the Income Tax Act 1961. When we do that, it takes a very holistic approach, which is what happens in practical life. But we are all academics right now. We are in the academic chair. So you will have to understand Ind AS 12 on a standalone basis. You will have to understand Ind AS 12 as it is. There may be some common area with the Income Tax Act 1961, which is very good. I will definitely correlate to what provisions we have to the extent I know, of course. To the extent I know, you can also correlate because all of us have completed our intermediate. To that extent, I will definitely correlate. But there may be some adjustments. There may be some aspects given in Ind AS 12 which is not presently there in the Income Tax Act 1961. So do not jump to the question saying that, sir, this is not there in Income Tax Act, how it is there in the standard. Standard has to be more holistic, more wide in its approach, right? Tomorrow, if the Income Tax Act amends certain provisions, I cannot always have an amendment in the Ind AS based on my Income Tax Act. My Ind AS must be more holistic in its approach. So therefore, we are covering a much broader framework as compared to just the Income Tax Act. So this is the background with which I request you to approach Ind AS 12. All right. So let us now commence Ind AS 12 that deals with income taxes. Okay. Let me just share the screen. All right. Okay. So a technical standard, but we shall proceed a little slow than normal so that all of us can understand and all of us are on the same page. But I cannot go extremely slow as well because we have a lot of things to discuss. So let us come to the standard as it is. What will we be discussing in this standard? We will be covering what is the objective of Ind AS 12. That means why this Ind AS 12 had to be issued. And then we had an erstwhile standard in the ICAI regime also, that was AS 22, which dealt with again taxes on income. So there was a previous standard AS 22. We will see what was the approach of AS 22 in brief, of course, and we will see what is the change that has been brought about by Ind AS 12. There is a very fundamental shift in the manner in which we approach income taxes. So we will be seeing that. In brief, you will not be examined on AS 22, but the manner of computing will definitely help. Then we will be discussing definitions under this standard. What are some of the important definitions? And we will mainly focus our discussion on deferred taxes. All of us would be aware, all of us know what are deferred taxes. Those of you who are not very much exposed to deferred taxes, I hope that you will, at the end of this session, be familiar with the terms and be familiar with the manner of computing deferred taxes. So we will be discussing deferred taxes, how to compute deferred taxes, what is the methodology involved, that means, and then the various steps, which is given exactly as in your study module. So I'm not departing from your study module. Then we will discuss certain special cases of certain aspects like business combinations or deferred taxes in the case of share-based payments. Those aspects are what we will discuss. This, I will of course not be able to cover everything today. The special cases will go to the session on Monday, and even some of the steps of deferred taxes will go thereafter to the next session on Monday. But we will try to cover as far as possible the major crisp definitions and a detailed understanding of the concepts, which will make our sailing on Monday smoother. Then we will of course be discussing the disclosures. As far as the disclosures in any Ind AS goes, the disclosures are extremely wide, they are extremely detailed, and they will be what you can say, they will be giving far more information to the users of your financial statements. So with this background, let us now jump to the objective of Ind AS 12. What is the objective? Why this standard had to be, why this standard had to come in force? This one has come now, but there was an AS22 earlier. So why do we have this? We have this standard to prescribe the accounting treatment for income taxes. So the question arises, sir, when we talk about income taxes, what exactly do you mean by the term income tax? What is covered under income tax? Is it only the tax that is levied on income under the Indian Income Tax Act 1961? And the answer is no, it is not restricted to that. The Income Tax Act is there. That is like a major thing. But additionally, we are also having any taxes on income that are levied on, for example, foreign incomes. You have a branch outside India. On that, you will be levied income tax. The income that is generated by the branch is taxed under the income tax laws of that country. So therefore, that tax also will be covered under income taxes. Dividends that are distributed, that also is an income. So the dividend distribution tax also will be covered. The dividend distribution tax also will be covered. But what will not be covered? Any investment credits or government grants, any investment credits or government grants, they are excluded from the scope of this. But the tax impact on these two items will be covered. The income tax impact of these two items will be covered under Ind AS 12. So now with this coverage of income taxes, let us now look at what is the reason behind introducing this. It provides the accounting guidance for the current and future tax consequences. The standard discusses current tax in a very small manner. In the sense, it is a very simple concept. We do not have much explanation for that. But the standard covers in great details deferred taxes. The standard covers in great details deferred taxes, which we will also be examining in a great detail in the discussion to happen. So the current and future tax consequences, that is the tax impact of future recovery or settlement of the carrying amount of assets or liabilities that are recognized in an entity's balance sheet. That is what we will be examining. So what do I mean future recovery of an asset? Whenever an entity purchases an asset, whenever it acquires an asset, obviously it acquires the asset with an intention to monetize it, with an intention to get benefits from that, with the intention to earn money out of that, with the intention to generate income out of that asset. And I'm not restricting myself to I'm not restricting myself only to a fixed asset. I can talk about inventories. Let us assume a trading concern purchases goods. Why does it purchase goods? Because it wants to sell them and make money. Why does it purchase a fixed asset, an item of property, plant and equipment? Very simple. It wants to get the benefits, the economic benefits from that. Like for example, if it is a machine, in that scenario, I could use that machine to produce goods, and those goods I can sell. So therefore, the sale proceeds of the goods is the recovery of the asset, is the recovery of the amount of the asset. Ultimately, as a business entity, whenever you make an investment, the intention has to be to recover the amount of that investment and make a profit. If you do not want to recover at all, why are we investing in assets? And not restricted only to fixed assets. Any asset, I'm talking about any asset. You make a credit sale. Why are you making a credit sale? Because you want to increase your sales, reach out to more people, knowing that you are giving a credit. Therefore, your debtors increase. So what are you doing? You are essentially, I can say, passively investing in debtors. I will not say actually putting money, but you are investing in debtors. Why are you investing? Tomorrow, these debtors will be monetized. Tomorrow, these debtors will be monetized and you get economic benefits from them. So that is also going to be one of the examples of future recovery of carrying amount of assets. Future recovery of carrying amount of assets. It also covers the tax consequences of settlement of liabilities. So therefore, in this standard, as I will explain now, we are adopting a balance sheet approach wherein we look at each asset and each liability and we check what will be the tax impact of the future recoveries that will come from here. What will be the tax impact of the future settlement of my liabilities? Like, for example, if you have received an income in advance, what is going to be the tax effect of that income? Does the tax statute tell you to tax it on cash basis? Does it permit you to account for this on accrual basis? Because sometimes we are having certain provisions where the Income Tax Act tells us that income should be recognized when accrued or when received, whichever is earlier. So therefore, when income is received in advance for my financial accounts, it is a liability. I cannot book a sale because I have not yet fulfilled the conditions of sale. But by virtue of my Income Tax Act provisions, certain provisions, I may have to tax it. So therefore, there is a tax impact of the revenue received in advance. So therefore, how you intend to settle this liability? Do you intend to settle this by providing a service? Do you intend, if you have taken a loan, if you have taken a borrowing, then if this borrowing has to be repaid. So obviously, what will be the tax consequence of repayment of borrowing? The answer is no tax consequence. Why? Because what money you got, you are just repaying it back. So therefore, there is no income in this transaction. So therefore, the standard covers all these aspects in detail. The standard discusses what is the current tax consequence. It also discusses what is the future tax consequence. So this is what we will be discussing. The standard also discusses what is the consequences of transactions and other events of the current period that are recognized in an entity's financial statements. In the course of operations, we are having many transactions, many events. Transactions could be your day-to-day transactions, like you purchase inventory, you sell the inventory. These are the items which would normally be recognized in your profit and loss account. So therefore, the standard tells us items which are normally recognized in the profit and loss account, the related tax impact also you recognize it in the profit and loss account. This is what the standard tells you. But apart from this, there may be some items which are recognized outside the profit and loss. It is a transaction, so it must affect the financial statements. But it may not be recorded in the profit and loss account. It could be recorded outside. Like, for example, revaluation of property, plant and equipment. Now, revaluation of PPE, where is it recorded? It is recorded in OCI and taken away straight to your revaluation surplus. It is taken straight to your revaluation surplus. Since the revaluation is not coming in the P&L, the tax effect of that revaluation, which we will see in our example, will not come in the P&L. Rather, it will be in your OCI. There may be certain transactions which are directly recognized in your statement of changes in equity. Directly it goes to equity. It does not come here at all. Like, for example, what? For example, it could be distribution of profits when you are issuing dividends. Where does dividends go? It does not come in my profit and loss account. It does not come in my other comprehensive income. It is a transaction between the company and its owners. So therefore, it is directly recorded in your equity. So the tax impact of that distribution is covered. Yet another example, you issue a convertible debenture. You issue convertible debentures. My standards on financial instruments tell me you will have to split this into an equity component and into a liability component. The liability component will go to the balance sheet, whereas the equity component is directly recorded in your equity. It is directly recorded in other equity. It will not flow in your profit and loss account. It will not flow in your P&L, and therefore the tax effect of these items will be recorded in the statement of changes in equity. So this is what this standard tells us. This is what the standard tells us. For the time being, we will not focus on the second aspect, that is transactions and other events that are recognized in an entity's financial statements. We will set it aside. We will discuss this later as the discussions proceed. But I want us to now focus on the main item, that is the tax consequences of the future recovery of assets or future settlement of liabilities. What will be the tax consequences? Let us understand with the help of an example that is given in your study module. Now, this is the example on page number 10.6 and 7. An entity recognizes an item of land at rupees 1 lakh. So initially when I purchased the land, I would have passed the entry land or property, plant and equipment account debit 1 lakh to cash bank 1 lakh rupees. So this is the entry that I pass. Land is there at 1 lakh rupees. The income tax provisions assuming provides that if this piece of land is sold after 1 year, there will be an indexation benefit at 10% per year. So therefore, the value of land, which is 1 lakh, will be 1,10,000 in the next year. It will be 1,21,000 in the at the end of the second year. Likewise, it proceeds. The tax rate in all the years continues to be flat 30%. Discuss the deferred tax implications if the asset is sold after 2.5 years. Don't get confused by the word deferred tax. Don't get confused by the fact that we are doing a deferred tax. Why? Because deferred tax is nothing but a tax consequence that arises in the future. It is nothing but a tax consequence that arises in the future. And therefore, I request you not to get worried. Now let us look at this problem and see what will be the impact of this. Now I will just stop sharing. You have this in your study module. So let us just have a look at this. In your financial statements, when you purchased this land, you paid rupees 1 lakh. So today, this land is sitting in your balance sheet at rupees 1 lakh. Tomorrow, what can happen? You may decide to monetize this land. You may decide to sell this land. I'm keeping a very simple example. And I am saying after 2.5 years, the value of this land is, let us assume, 1,50,000. So value of land that you intend to sell after 2.5 years, is 1,50,000. So when you sell it actually for 1,50,000 after 2.5 years, you will actually make a profit of 50,000. And what has the problem said? The tax rate in all the years continues to be 30%. So we are discussing with the tax consequences. So if I look purely from an accounting perspective, my expected profit is 50,000. So therefore, purely from accounts, I have not yet coming to the tax. Purely from accounts perspective, your tax at the rate of 30%, this is just not considering tax consequences. Okay, not considering tax gain. Okay, so therefore 50,000 into 30%, you expect without a knowledge that 15,000 could be your tax. But let us look at the tax impact. Your land, when you purchased, was for 1 lakh. And what the act has given you? Year on year, the indexation will be at the rate of 10% for tax purposes only. This is not revaluation. You have not revalued your land. So therefore, because of this indexation benefit, 1 lakh into 1.1, this is price, the indexed amount of land at the end of first year multiplied by another 1.1. This is at the end of the second year. So therefore, your land will be 1 lakh into 1.1 into 1.1. Now this land is for tax purposes worth 1,21,000, worth 1,21,000. Is it okay? Yes. When I say it is worth 1,21,000 for tax purposes, what does it mean? It means when I sell this land for 1,50,000, I will be getting a corresponding reduction of 1,21,000. See, this is what I mean by the future recovery of an asset. I am recovering the cost of this asset. I am recovering the cost of this asset by monetizing it, by selling it in this case. So when I recover, I am going to make a taxable profit. I am going to make a taxable profit of how much? I am going to make a taxable profit of 29,000. Now you can appreciate why this standard is required. For accounts, do I have indexation? No, sir, I do not have indexation. So therefore, for accounts, your value will be 1 lakh rupees. Your value will be 1 lakh rupees. Please, I'm not covering the aspect of revaluation, etc. right now. I do not want us to get confused. So 1 lakh rupees is your value for accounts. For accounts, your profit is 50,000. But for tax purposes, you are getting an appreciation in your value. Why is that appreciation? Because of a tax given indexation. The statute has given you the benefit of indexation. So your profit will be 29,000 for tax purposes. On that, at the rate of 30% means tax at the rate of 30% means 8,700 is the tax that you will pay when you sell this land. Now look at the tax consequences. The indexation benefit was given. By virtue of the indexation benefit, what has happened? Your tax has come down from 15,000 to 8,700. Why did this happen? Did you adopt any tax saving technique? The answer is no. I did just what the statute has allowed me to do. The statute has given you the benefit of indexation. So therefore, your profit has come down from 15,000 to 8,700. That means it is now 6,300 rupees. This is a tax saving that is happening to you. This is a tax saving that is happening to you. Why this saving has happened? Because land which was worth 1 lakh rupees increased to 1,21,000 on account of indexation. So 1 lakh minus 1,20,000 into 30% is 6,300, which is exactly the amount of benefit that I have received. So therefore, today when I invested, I know this, that I may have to pay 15,000. But you also know that there is a tax consequence. You know that there will be an indexation. And by virtue of this indexation, you know that you will get an appreciation of 21,000 for tax purposes deducted. So therefore, you will end up saving 6,300 rupees in tax. Now, this is a very simple and a very, what I can say, a very elementary and crude example for us to understand what we were discussing. Why do I use the word elementary and crude? Because in real life, it doesn't happen like this. In real life, number one, do I have any, what you can say, set indexation figures saying that 10% year on year, you will get an increase? And the answer is no. My indexation figure, the cost of inflation index, which all of us are aware of, the capital gain, for capital gains, you have a CII that is given to you. That is coming out every year. You do not know the future values of CII. It is seen on the basis of your inflation, on the basis of your prices, and then it is decided in each year. So do I know this 10% indexation? The answer is no, I do not know. Number one. Number two, I cannot recognize this gain of 6,300. Why? Because I do not know the indexation amounts themselves. I do not know the indexation amounts themselves. So therefore, on account of this simple reason, we do not do this in real life. We do not do this in real life. You know what happens if, sir, we can also estimate, we can estimate cost of inflation index. Ind AS is always permit us to estimate. We have a separate standard also, Ind AS 8, that deals with estimates. Then why do we not do an estimate? We do not do the estimate because if I do the estimate, you know what happens? My estimates may go wrong, number one. Sir, we'll do a catch-up adjustment later on if it goes wrong. All right. But worse, what will happen is you are recognizing an asset. You are already recognizing an asset. What asset? You are recognizing a deferred tax asset. You expect 6,300 to be saved in the future. It is your expectation. So what is the entry that you pass? Deferred tax asset account debit. It is an asset. Since it is an asset that is being created, you will credit your profit and loss account. You will credit your profit and loss account. Means in effect, we are violating the fundamental principle of conservatism, of prudence, which says that gains should not be recognized unless they are realized. You can recognize a liability when it is probable to be realized. In fact, when we study Ind AS 37, you will appreciate that the guidance that is given for recognizing a provision is probable. The guidance that is given for recognizing a provision is probable. More than 50% possibility of happening, recognize a provision. But for an asset to be recognized, the requirement is there must be more than 95% of the asset to be of certainty. That means virtually you are certain that the asset will arise. You should be virtually certain. Here I will be playing with lot of estimates. The asset is not virtually certain of realization. So I am going to have a problem in Ind AS 37 also if I recognize this. The standard tells no, you are not permitted to recognize. Why? Because there is no virtual certainty. It is your estimate. For contingent asset, it is nothing but a contingent asset. An expected tax saving, that means an expected benefit that depends on future events. What is the future event? The future event is I should get this indexation of 1,21,000. That is my future expectation. So this expectation is not in my control today. So therefore, what does it become? At best, it becomes a contingent asset. And Ind AS 37 tells me we cannot recognize contingent assets. We can only disclose them. So therefore, this treatment, you will not find it in your real life. Why? Because it is not permitted. It is too controversial. It's not permitted. So therefore, we do not recognize. If this is allowed, you know what would be the scenario? Every company would start creating deferred tax assets to increase the profitability. You would have inflated profits running around in the market, and then they would probably not even be realized. So therefore, the standard on Ind AS 37, that is provisions, contingent liabilities and contingent assets, does not permit it. Therefore, this is not allowed here. All right. So with this, we have now understood what is the purpose of this standard. The future impact that is there of recovering an asset, we will have to determine that. That guidance is what is given by the standard. That guidance is what is given by the standard. So let us now proceed to the next part. Till now, I hope it is clear. I hope there are no doubts. I hope everybody is with me. Let us now proceed to the next slide. There are some definitions. All right. So what are some of the definitions that we need to know? Well, the first definition is accounting profit or loss. which is nothing but profit or loss for a period before deducting tax expense. Before deducting tax expense. When I say before deducting tax expense, please remember, normal accounting profit is net profit after taxes, the ultimate profit that the enterprise has generated. But for the purpose of this standard, it is before deducting. That means NPBT, net profit before tax, after deducting accounting, depreciation, etc., etc. Now, what do you mean by taxable profit or loss? What do you mean by taxable profit or loss? That is nothing but the net taxable income as per computation of your income. You all have done profits and gains from business and profession. All of you are familiar with the manner of computing. Nevertheless, I have kept one question just to calculate the taxable income when I am given the accounting income. I have kept one sum. I will mention the reason behind keeping that sum. That is not given in your study module. In fact, I don't think such a problem may come also, because the standard has far more concepts to examine you on rather than preparing a computation of income. But that is just for my friends who are probably exposed only to audit and related areas in their articleship, that I could explain to them how exactly we account for the tax liability. So to arrive at taxable profit, you start with accounting profit. It's exactly the computation of income in PGBP. Add expenses recognized in your profit and loss account, but non-deductible for tax purposes. Example, 43B payments where deduction is allowed only when paid. Like for example, finance cost in respect of a loan that is taken from a scheduled commercial bank. What does 43B tell me? In respect of loans that are taken from scheduled commercial banks, interest is deductible only if it is paid. If you have not paid the interest, you will not get a deduction. 43B further goes on to tell us that if you pay this amount even up to the date of filing the return of income, you will be getting a deduction. So therefore, when I say non-deductible for tax purposes, it means these payments have not materialized at all, even at the time of filing the return. So therefore, you will not get a deduction of them. So therefore, you will not get a deduction means to that extent your profit will increase. To that extent your profit will increase. So therefore, you will add the expenses which are recognized in financials but which are non-deductible for tax purposes. You will also add income not recognized but included under tax laws. For example, revenue taxed on receipt basis. Now see, in accounts, we will have to follow accrual concept. Again, I'm taking an example for you to understand. In accounts, we will have to follow the accrual concept, but sometimes you may get interest which could be taxed on a cash basis. So in your accounts, if you have a deposit in a bank, you will accrue the interest only when it has actually accrued. You will accrue it only when the accrual has actually happened. But let us assume that you have received the interest today for an advance. You have received interest in advance. The moment you invest the deposit, the moment you invest your amount in the deposit, the bank gives you the interest today. A very hypothetical example. And then it says after the end of 1 year, when the deposit matures, we will give you the principal. So therefore, when this is the scenario, you received the interest today, but it has not yet accrued. So for accounts, you will not record the income, but for tax purposes, it will be recognized. Why? Because for tax purposes, it is income that is received in cash will be recorded on a cash basis. So that is the reason this will be included in your taxable income. This will be included in your taxable income. Less expenses not recognized but deductible for tax purposes. Simple example is accelerated depreciation. Simple example is accelerated depreciation. In Companies Act, you follow the concept of useful life. Normally, you have to estimate the useful life and deduct your depreciation accordingly. But for tax purposes, you are given that section 32 and then that I hope I'm conveying the right section numbers. You are given a section on income, on depreciation, and you are also given the related rules which prescribes the rates of depreciation. You have to compute the depreciation according to the rates mentioned in those rules. Sometimes it may so happen that the rate in income tax is higher, whereas what you claim in the Companies Act is lower. What you charge in the Companies Act is lower. So when that is the scenario, you will have a higher depreciation in Income Tax Act, which is deductible. So therefore, you will reduce that depreciation for tax purposes, whatever is the excess amount. Less income recognized but not under the tax laws. Example is income accrued but taxed on cash basis. Like for example, the fixed deposit again that I'm talking about. Now, suppose you have a 3-year fixed deposit. The interest you will receive when the deposit matures. But for accounting purposes, you will record the interest. I am giving a simple example, 1/3, 1/3, 1/3, simple interest. In reality, it won't be 1/3, 1/3, 1/3. Reality is compounded interest. So 1/3 interest you record at the end of year 1 in accounts. But will you tax it? The answer is no. Why? Because in this case, the tax statute tells you that you will have to tax it on cash basis. That means at the end of the 3rd year, when you receive the deposit along with the interest, at the end of the 3rd year, you will tax it. So since it is included in the accounting profit, you will have to reduce it. So when you do these additions and subtractions, what you will get is your taxable profit or loss. That is your profit or loss for the purposes of income tax. For the purposes of income tax. It could be any tax, okay, not necessarily the Income Tax, not necessarily the Income Tax Act 1961. We will be covering a broader scope, as I always told you. So this taxable profit or loss is nothing but the profit or loss for a period that is determined in accordance with the applicable tax rules. That is determined in accordance with the applicable tax rules. Whatever tax rules you are, whichever jurisdiction you are, apply those tax rules to arrive at the taxable profit. All right. So with this, let us proceed to the next question. Let us proceed to the next. This is an illustration that is there for you. It is not there in the module. It is unlikely that you will be examined on this. Okay. But this is just to give you an application of what we have done. This question is very important because as we move ahead in the discussions on this standard, once I discuss a concept, I will again come back to this question. This is like a pivot question. This is what happens in real life. All right. So therefore, please keep this question as a, what you can say, a reference point. I hope you people have downloaded the presentations. Okay. So this question will be revisited time and again after we understand the concept with the help of other examples. It's a very simple question. You will definitely be able to do it. I will be doing it with you. H Limited wants to calculate its taxable profit or loss for the year ended 31st March 20x8. The statement of profit or loss and other comprehensive income, the statement of financial position, that's the balance sheet, and the notes are given below. Tax rate for the financial year X7, X8 is 30%, but the new rate of 32% for the year X8, X9 and beyond has already been enacted before the year end. What is the significance of 32%? We will see when we do deferred taxes. Right now, we are computing just the taxable profit. So calculate the taxable profit for the financial year 7-8. And for 7-8, the tax rate is how much? 30%. And you will have to compute the related current tax expense. You are given extract of P&L and OCI for the year ending X8. You are having revenue 16 crores 81 81 lakhs 40,000 less cost of sales, giving you a GP, less operating cost, giving you profit from operations, less finance cost, giving you profit before tax of 59 lakh 50,000. This profit before tax is what is your accounting profit. This is what is your accounting profit. So you can write down accounting profit. You can write down accounting profit is how much? 59 lakhs 50,000. Accounting profit is 59 lakhs 50,000. And with this accounting profit, we shall now proceed to the taxable profit, following the notes which are given to us. You are also given the balance sheet of this company as at 31st March X8. What is there in the balance sheet? We will just run through briefly, although right now I will not need the application of this. PPE 4.2 crores, intangible assets 21 lakhs, which is product development cost, investment in subsidiary 1.54 crores, trading investment 72.8 lakhs, trade receivables 2.19, 2 crore 19 lakhs 10,000, inventories 1 crore 6 lakhs 40,000, cash and cash equivalent 63 lakhs. On equity and liabilities, you normally have a vertical balance sheet, but for the purposes of what you can say space paucity, I have just given it in a T form balance sheet. That also I started with assets and moving on to equity and liabilities. Okay, so you are having equity share capital 4.2, retained earnings 2 crore 86 lakhs 24,330, reval surplus 30 lakhs 80,000. Long-term liabilities, you are having deferred income, that is government grants. You have studied Ind AS 20, I hope. In that, you know what is deferred income. So 14 lakhs is there in your balance sheet. It will be taken to your income over the next period, okay, over the subsequent periods, depending on the terms and conditions of the grant, of course. Liability for product warranty costs 5 lakh 60,000. Deferred tax liability from 20X6 20X7. This is your opening balance of deferred tax liability 775 670. We will see what is this opening balance later on. In current liabilities, you have trade payables 2 crore 67 lakhs 40,000 and medical benefits for employees 24 lakhs 50,000, giving a balance sheet total of 10 crore 56 lakhs 30,000. I hope you are having this question. And now we come to the notes. Now these notes give me the guidance under the income tax. See, again, I'm saying don't compare this with Indian income tax. Okay, it is a general tax guidance. Some may be as per Income Tax Act, some may not be as per Income Tax Act, but they are a tax treatment nevertheless. It is not there in our act does not mean it is not there in other countries' act. All right. Remember, this IAS 12 has a very, very wide scope. So therefore, we will be covering other items also, which may not be there here. But as long as our concepts are clear what we have to do, there should not be any difficulty. So now, depreciation expense for FY X7 X8 allowed as per the income tax rules is 72 lakhs 10,000. So this adjustment, all of us know what to do. Depreciation as allowed for the purposes of financial reporting included in operating costs is 59 lakhs 50,000. So depreciation is 59 lakh 50,000 as per the books. As per the tax, it is 72 lakh 10,000. So you will add 59 lakh 50 because that is not allowed in tax laws, less 72 lakh 10,000 that is allowed for income tax purposes. Cost of PPE is 5.6 crores. H Limited deducted expenses of 1 crore 45 lakh 60,000 in its tax returns prior to X7 X8. That means what? What is this 1 crore 45 lakh 60,000? This is nothing but the accumulated depreciation that is computed as per the income tax laws. That is computed as per the income tax laws. We need this later on when we are doing deferred tax. Okay. Further, as of 31st March X8, For the first time, H Limited for the first time revalued its property, plant and equipment to the market value of 4.2 crores. We saw the reval surplus 30,80,000 in the balance sheet, right? We saw the reval surplus of 30,80,000 in the balance sheet. So there has been a revaluation. Where does this revaluation go? Does it go to your P&L? The answer is no. It goes to your OCI, from there to your revaluation surplus. So it is not there in the P&L. So we will not consider it temporarily. So therefore, what will be the effect of this adjustment for this problem? You will write add back, or you can write disallowed or considered separately, something that we do in our computation of income. So add back accounting depreciation, add back accounting depreciation. What is my accounting depreciation in this problem? My accounting depreciation is 59,50,000. I hope all of you are with me. I'm taking it from a very, very low, what you can say, base level, so that we are all on the same page. The standard is technical. I don't want us to lose track in light of the concepts that are there. So I'm taking from a very, very base level. Okay. Less what is allowed for tax purposes. So tax depreciation. What is your allowed figure? Tax depreciation allowed figure is 72,10,000. 72,10,000. Next, in X4, X5, that means 3 years ago, I think. Yeah. H Limited incurred product development cost of 35 lakhs. All right. These costs were recognized as an asset under Ind AS 38. And they were amortized for 10 years, over 10 years. Okay. For tax purposes, H Limited deducted the full development costs in X4, X5. So 35 lakhs amortized over 10 years. So 35 lakhs divided by 10, depreciation for the period must be 3,50,000. Sorry, amortization for the period must be 3,50,000, which is debited to your profit or loss. Since that is not allowed, you will add back. Will you deduct the development cost of 35 lakhs again? And the answer is no. Why? Because they have already been deducted for tax purposes earlier. So therefore, you will only add back amortization. What is your amortization? 3,50,000. Amortization is 3,50,000. Next, trading investments were acquired in 6-7 at a cost of 80,50,000. These investments are classified as at fair value through P&L. So we all know what is an investment. It is a financial asset. A contractual right to receive cash, or another financial asset. So this is a trading investment. It represents a contractual right to receive cash or another financial asset. So therefore, we have now opted to, since we have invested in equity, we have now opted to take it as a fair value through P&L. So what is your fair value through P&L means? Every year at the balance sheet date, you look at the market value. That market value, you compare it with what? You compare it with your book value. Any movement in the market value and book value, you will take it as a catch-up adjustment and record it in your P&L. Any movement. This is like a mark-to-market transaction. Movement in the fair values at the end of each reporting day, at the end of each balance sheet date, will be recorded in the profit and loss account, thereby bringing your financial asset to the market value. All right. These investments are classified as FVTPL and thus recognized in their fair value. Fair value adjustments are not allowed by tax authorities. So what does the taxman tell you? Look, I cannot be allowing you movements in fair value, but I can definitely give you this. Whatever be your selling price when you sell, I will give you a deduction of 80,50,000, which is the cost. So in other words, this is politely saying, sir, for income tax purposes, the value of your investment is 80,50,000. Movements in FV in fair value will not impact my tax figures. So let us look. The trading investments are appearing at how much in the balance sheet? The trading investments are appearing at 72 lakhs 80,000. 72 lakhs 80,000, whereas you purchased them for how much? You purchased them for 80 lakhs 50,000. You purchased them for 80 lakh 50. So the fair value has gone down. The fair value has gone down. By how much has it been reduced? 80 lakh 50 minus 72 lakhs 8. So that 7 lakhs 70 and brought it at 72 lakhs 80. Now this expense reduction in fair value is not allowed for tax purposes. So you will add back the revaluation, add back revaluation on trading investments, on trading investments. All right. Next, so this is 7 lakh 70,000. This is 7 lakh 70,000. Next, the next part is bad debt provision is 45 lakhs 50,000. All right. And it relates to two debtors. Debtor X 28 lakhs, receivable of X5, X6. That means 2 years ago, 100% provision was recognized in X6 and X7. All right. So last year itself, I had recognized complete provision. And debtor Y 17 lakh 50. You can see 28 lakhs plus 17 lakh 50 gives you 45 lakhs 50,000. Okay. Receivable of X6, X7, 100% provision, 100% provision was recognized in X7, X8. Tax laws allows deduction of 20% of provision for debtors overdue for more than 1 year. Another 30% for debtors overdue for more than 2 years, and remaining 50% for debtors overdue for more than 3 years. So you are having the deduction that is permitted, the RDD that is permitted, that is 20% overdue for 1 year, another 30% overdue for more than 1 year, and another 30% and another, sorry, overdue more than 1 year is 20%. Overdue for the next more than 2 years is 30%, and more than 3 years it is overdue, the remaining 50%. So it has to be overdue for more than 3 years to qualify for 100% deduction of RDD for tax purposes. All right. So how do we do this in your tax records? Now, this is not there in our Income Tax Act. Okay, so this is just an example that is given for your practice. All right, so don't think, sir, where is this provision in Income Tax Act? It is not there. All right, so let us come to the adjustment part. Let us come to the adjustment part. I hope all of us are together in this. I'll stop the sharing because I have to do this on the whiteboard. I'll stop the sharing. Let us do this on the whiteboard now. All right. Now, debtor A. Debtor A. What is the value of debtor A? The value of debtor A is 28 lakhs. The value of debtor A is 28 lakhs. And this is due from which period? This is due from 20x5, x6. I am in which year? 20x6. I am in 20x6, x7. All right. So therefore, therefore, more than 2 years, how much is allowed as a deduction for tax purposes? You are allowed 30% deductible. 30% deductible. So 28 lakhs into 30%. 28 lakhs into 30%. That gives you how much? 28 lakhs into 30%. That leaves you with 8,40,000. That leaves you with 8,40,000. All right. This is the deduction that is available for you. This is the deduction that is available for you for tax purposes. Now, debtor B. Debtor B. What is the value of this debtor? The value of this debtor is 17,50,000. That is given in the question. 17,50,000. That is given in the question. And this is a debtor of 6,7. This is a debtor of 6,7. All right. So now this is overdue for more than 1 year. This is overdue for more than 1 year. What is the deduction that you can get? 20% deductible. 20% deductible. So therefore, it will be 17,50,000 multiplied by 20%. So 17,50,000 multiplied by 20%, you will get a deduction of 3,50,000 for tax purposes. So your total deduction is 8,40,000 plus 3,50,000. 8,40,000 plus 3,50,000 total RDD, okay, reserve allowed, or total provision allowed. Total provision allowed is 11,90,000. This is your deductible item. All right. I'll just wait for 5 to 10 seconds. If anybody has any doubts, please ask. All right. I'll just wait for 5 to 10 seconds. If anybody has any doubts, please ask. No doubts? No doubts? So far we are on the same page. Yes. All right. I'm happy. It's an elementary question. Okay. It is an elementary question. It won't be difficult. Okay. When you are at this level, you will definitely find this manageable. Okay. So with this, let us come to the problem now. All right. Let us come to the problem. Yeah. Bad debt provision is 45,50,000. Okay. And it relates to two debtors. Debtor X 28 lakhs. 100% was recognized in X6, X7. That means in the last year, this debtor has been fully written off. Provision has been created entirely in the last year. So for financial accounts, nothing is in respect of this debtor. But in respect of debtor Y, 17,50,000, receivable of X6, X7. The debtor came last year, 100% is recognized in the current financial year. That means in your books, you have recognized a bad debt provision of the debtor wise balance, that is 17,50,000. But are you allowed 17,50,000? The answer is no, sir. We are allowed only 11,90,000. So add what you can say, provision for bad debts. Provision for bad debts, which is in respect of what? Which is in respect of X7, X8. Current year. Current year, how much have I charged? Current year, I have charged 17,50,000. I have charged 17,50,000. Yeah, Kaustubh, thank you. No doubt, sir. Please proceed. You have charged 17,50,000, not allowed. So add provision for bad debts. How much is permitted? Bad debt provision. How much is permitted? Permitted is 11,90,000. Sir, please don't lose sight of what is permitted also. Okay. In the midst of just disallowing, let us not forget what is allowed also. So therefore, this is allowed and 11,90,000 is allowed, 17,50,000 is disallowed. Let us proceed to the next set of notes. All right. Yeah. H Limited created a provision for inventory obsolescence in accordance with Ind AS 2. All right. So you have inventory obsolescence in Ind AS 2. You may have studied or you may be studying now. all right, yet to study. So therefore, if your inventory goes below the cost, so you have to state it at NRV, so you have to create a provision. So this provision was 3,78,000, the total provision being 6,30,000. So current year provision is 3,70,000. Being a general provision, this is not tax deductible. This is not tax deductible. So income tax will tell, see, I will give you the deduction of cost only when you actually sell the inventory. I will not give you a deduction for these general provisions, because anybody can play around with general provisions. Tomorrow when you actually sell the asset, you will realize below the cost. So that time I will give you the benefit of the loss. But now I cannot give you the benefit of the provision. But we have to follow Ind AS 2. So when we have to follow Ind AS 2, we will have to create this provision. So therefore 3,78,000 you have made the provision, you will add it back. You will add back. So inventory obsolescence. Inventory obsolescence. All right. How much is the provision? 3,78,000. 6,30,000 is the total provision. That is the balance sheet figure. That is not required right now. That is not required right now. All right. Next. Government grants are not taxable. Government grants are not taxable. By the way, where is government grant in this problem? Government grant in this problem is already there in the balance sheet only. It's not yet come to your P&L. It's not yet come to your P&L. So therefore, the revenue thereon has not yet been recognized. The revenue thereon has not yet been recognized. And according, full government grant received in X7, X8 is included in the statement of financial position as a deferred revenue grant. Sir, I got the grant, but still now I have not recognized the income on that. That means it has not come in your profit and loss account at all. So please don't go and reduce it. All right. First, it must be added to income, then you can reduce. All right. In this case, addition only has not happened. So therefore, do not reduce. There won't be any treatment of this for the purposes of calculating the taxable profit. All right. Next, in X7, X8, H Limited increased a liability for product warranty cost by 1,75,000 rupees in accordance with Ind AS 37. All right. So whenever you sell goods which are having a warranty, which are backed by a warranty, then the sale is an event that obligates you to create a provision. All right. How do you make the provision? Based on the best estimate. So you assume you sell 10,000 units in a year, and you think on an average about 2% of the units go bad. So therefore, for 200 units, you will make a provision for bad debts. You will make a provision for warranty cost. All right. But this is a general provision. Again, this is a general provision. If taxes had to allow this, people would play around with the provisions. So therefore, for Ind AS 37, I have to make. But for tax purposes, the problem tells us that product warranty costs are not tax deductible until the company pays the claims. So when the company makes the payment, that time you will get a deduction. So claims paid in X7, X8 amounted to 2,17,000. Excellent. So therefore, product warranty cost, that is the provision that you have made. So provision for product warranty. Provision for product warranty. This is how much? This is 1,75,000. The provision that you have made. All right. And then claims paid in X7, X8 amounted to 2,17,000. This is deductible. You are actually making the payment, and the act, the respective statute allows a deduction when paid. So therefore, warranty claims paid. Warranty claims paid. So that will be how much? That will be 2,17,000. That will be 2,17,000. Next. During the year, H Limited introduced medical benefits for employees. The expenses are allowable for tax purposes only when the benefits are paid. but in line with Ind AS 19, recognized in profit or loss when the employees provide a service. Okay. Now, during the year, H Limited introduced healthcare benefits. All right. So now, were there healthcare benefits below? The answer is no. It has been introduced in the current year. So what does Ind AS 19, that is the standard on employee benefits, tell me? It tells me that as the employee provides service to the entity, you recognize the expense, you recognize the compensation expense in respect of that. You may settle this compensation in many ways. You may settle it by way of cash salary, which is measurable. You may measure it by way of perquisites. You may measure it by, you may give the compensation by way of ESOPs, which we have covered in Ind AS 102. You may give a compensation by way of a pension in the future. But why are you giving him a future pension or a future medical benefit? Because he has served you today. So the expense has accrued today. So therefore, Ind AS 19 tells you have to estimate that expense today and make a provision. So in line with that, you have made a provision of how much? Sir, amount is not given. Sir, amount is given in the balance sheet where they have said 24 lakh 50. Why I take this figure? Because the provision has been created only now. That means in X7, X8. So it would have been debited to the profit and loss account, and you have set aside this amount, medical benefits for employees. So therefore 24 lakh 50 entire amount will be added back, So provision medical benefits, when they claim, you will record the medical benefits provision account debit to bank. But for tax purposes, you will not make this provision. So therefore, you will deduct it on actual basis. So medical benefits provision is 24 lakhs 50,000. 24 lakh 50. Finally, penalties towards violation of laws included in operating expenses, that is 63,000. These are not deductible. So this we all know it is included, but for tax purposes disallowed. So fines and penalties. This is 63,000. Next, tax laws allow to deduct expenses for petrol only up to 1,40,000 per year. H Limited had 4 vehicles in X7, X8. So 1,40,000 into 4, you should have deducted 5,60,000. The total petrol expenses which you have charged is how much? 7,21,000. So what is the additional expenses? 7,21,000 minus 5,60,000. So petrol over limit is 7,21,000 minus 1,40,000 for 4 vehicles, that is 5,60,000. So you get in all 1,61,000 rupees. And that completes the notes. Okay. So after this, let us now come to the problem. I will stop the screen share so you can see the whiteboard. So add all these items and deduct those items. You will get how much? 50,000 plus 3,50,000, 770,000, 1,750,000, 378,000, 175,000, 2,450,000, 63,000, 161,000, 120, 47,000 will be added back. How much is deductible? 86,17,000. 86,17,000 is deductible for tax purposes. So when you do the add less, When you do the add less, 59 lakh 50 plus 120.47 minus 86 lakh 17,000, you will get a taxable profit of 93 lakh 80,000. When you do this add less, you will get taxable profit. You will get taxable profit of 93 lakhs 80,000. I hope this part is now understood. Now, the tax rate is 30%. So therefore, tax amount is equal to 93 lakh 80,000 multiplied by 30%. So that gives you 28 lakhs 14,000. That gives you 28 lakhs 14,000. This is your tax amount that you have estimated. All right. So far, is it clear? Yes. Take 10 seconds. Check your answers. If you have done, give me 1 or 2 confirmations and then let us proceed with the definitions now. Now you will be able to get an understanding of the definitions that we have. We'll wait for 5 to 10 seconds. All right. So this is fine. Let us now proceed. Now this, please keep this problem as a pivot. All right. This is your anchor for this chapter. All the examples that I give, I will keep revisiting this problem. Okay. I will keep revisiting this problem. So now at the end of the year, okay, Neha, thank you. Yes. So at the end of the year, the entry will be income tax expense account debit or the P&L, which will go to the P&L debit 28 lakhs 14,000 to provision for tax 28 lakhs 14,000. Sir, why do we take a provision for tax and not a tax liability? Number one, this is a self-assessed tax. Okay, in India, we always do a self-assessment. That is also common for others. So therefore, when we do a self-assessment, sometimes the government picks your case for scrutiny. That time there may be some additions or deletions. So until the time the scrutiny is over, number one, or until the time the time limit for giving your selecting your case for scrutiny is over. Until that time, normally we park it in provision for tax. Okay, this is something you know from intermediate stage. It is a liability whose timing is certain, but whose amount is a little uncertain. All right. It is an estimate only at the end of the day. Okay. You say you have followed the act, but does the taxman say? The answer is it depends. So therefore, provision for tax 28 lakh 14. So in this problem, 93 lakh 80 represents the taxable profit. 28 lakh 14,000 is what represents your current tax expense. 28 lakh 14,000 is what represents in terms of Ind AS 12. We call it as the current tax expense. The tax expense for the year that is computed based on the computation of income. All right. So in simple words, 28 lakh 14 is what is actually payable to the department, what is actually payable to the government. All right. So let us now look at the definitions. It will now be crystal clear. All right. So now tax expense is equal to current tax expense plus deferred tax expense. Deferred tax, I will come in a while. I have just now explained what is current tax. Amount of income tax is payable or recoverable in respect of the taxable profit or tax loss for a period. So in this regard, I have made a profit. 93 lakh 80,000 is my taxable profit. On that, the tax payable is 28 lakh 14 for the current year. So that will become your current tax expense or just current tax. All right. Next, what will be the treatment? taxable profit or loss multiplied by the tax rate, which is what we have done, 93 lakh 80 multiplied by the percentage of 30. So debit P&L account debit, and you will credit what? You will credit provision for tax. You will credit provision for tax. You will measure it at the amounts expected to be paid to the tax authorities. This is your expectation. Okay, so keep it in provision. This is not a final liability. This is your estimate of the liability. But the opposite party must accept your claim. Na? The opposite party is the one who is entitled to have a right on those tax. And they have a right to determine what will be the amount of that tax. So they have to accept your claim. Therefore, it is an estimate. Therefore, it is kept as a provision. It is kept as a provision. All right. So this is what is current tax expense and taxable profit. I hope this definition is clear and we have done this problem. Now we come to the pulse of this chapter. We come to the pulse of this chapter. All right, that is deferred tax. From now, the chapter actually starts to get technical. The chapter actually starts to get technical. All right. So let us jump into this deferred tax. So what is a deferred tax, sir? Deferred tax is an amount. These are amounts of income taxes which are payable or recoverable in the future in respect of temporary differences, unused tax losses, and unused tax credits. So it is nothing but temporary differences multiplied by tax rates. Temporary differences is the difference between your carrying amount and the tax base. A minus sign is missing in between. Sir, too many technical terms you have discussed and you have just read the definition. Okay, let us come to an understanding of this now. I will explain what is the problem. I will explain what is the problem in this question that we just now did. Then I will discuss a small problem, an example actually. Basis that example, you will come to know what is deferred tax. Many of you would already be knowing of, okay? But look at this case now. In this problem, my accounting profit was 59 lakhs 50,000. And the tax expense that you have charged is 28 lakh 14,000. So 28 lakh 14,000 divided by 59 lakh 50,000, the tax rate that will come is 47.3%. Any reader of the financial statements of this company will say, sir, your tax rate is 30%. Then how is this ratio coming? How is this ratio coming? Why are you paying additional taxes? Why are you paying additional taxes? Because he's a layman, all right. He's a layman. He only sees accounting profit 59. Do you think the company has to give? Do you think the company has to give this computation of income in the annual report? The answer is no, it's not required. So therefore, the investor will see only 59 lakh 50. He will see 28 lakh 14 and he will say tax rate is 47.3, but the statutory rate is 30%. So he will ask a question, where is this balance? 47.3%. And the purpose of Ind AS 12 is to give a meaningful reconciliation between 47.3% and 30%. That is the meaningful purpose of this standard. That is why you have a detailed guidance in the form of deferred taxes. Current tax explanation is done. The standard talks only this much, but the bulk of the standard now focuses on deferred taxes. And the disclosure part, the main important disclosure part is how this 30% became 47.3%. You will have to explain that. You could do it either numerically or you could do it in a percentage form. You can say what are the expenses allowed, disallowed, do the computation and give it. Otherwise, you can do a percentage-wise reconciliation and give it in your balance sheet. So then the investor will be satisfied. Acha, because of these reasons, 30% became 47.3. We will now examine the reasons for this difference. So when I do the problems with you now, I am discussing deferred tax. I will be discussing the concept of temporary differences. I will be discussing what is the carrying amount, tax base. We will see the various examples. But above all, I will come back to this problem because I have created a question here. Now I have to answer this question for you. So this is what happens in real life. This is what happens in real life. All right. So with this background, let us now park this question in the side for a second. Let us park this question into the side for the question. At the appropriate time, this will appear in front of you. All right. Now let us come to a simple example. Just a very simple example. A very common example. Most of you would be aware of it. Okay. Now year 1 and year 2. 2 years earnings before depreciation and tax, 1 lakh rupees. 1 lakh rupees. All right. Now when your earnings is 1 lakh, let us assume you have purchased an item of property, plant and equipment worth 1 lakh. You have purchased an item of property, plant and equipment worth 1 lakh. The useful life, I will keep it simple. It is 2 years. The useful life is 2 years, and the tax depreciation, this is a special equipment. So you are going to get 100% deduction in the first year. This is what is the problem. So you are going to now see what is deferred tax. What is deferred tax? So earnings before depreciation and tax is 1 lakh for both the years. Let me assume this. Minus depreciation. This is which depreciation now? This is accounting depreciation. This is accounting depreciation. 1 lakh divided by 2, it is 50,000. 50,000. So therefore 1 lakh minus 50, that leaves you with 50,000. So therefore your net profit before tax is 50,000. Let us assume that my tax rate is 30%. Let us assume my tax rate to be 30%. So now if we ignore the tax depreciation for a minute, your tax, just a minute, your tax at the rate of 30% should have been how much? It should have been 15,000. This should have been your tax expense. So the reader of the financial statements would say 50,000 profit before tax. Tax is 15, rate is 30%. It is matching, not a problem for me. But there is a tax consequence. So now you see the objective, the future recovery of an asset, the tax consequences thereof, how to account it. This standard provides guidance on that. So now for tax purposes, okay, earnings before depreciation and tax, it is 1 lakh. Same, no other differences are there. It is 1 lakh. Less depreciation. How much is your depreciation? 1 lakh rupees. Item is eligible for 100% depreciation. So therefore, your profit is 0 for the first year. Net profit before tax, 0. Tax expense at the rate of 30%. This comes to 0. So therefore, you will be having no profit. Right? So this is what you will take in your actual tax expense. Tax expense as per the computation. You will take it as 0. So 50,000 minus 0, 50,000 is your net profit after tax. 50,000 is your net profit after tax. So your investor at this point of time will be very much impressed by you. He says, Acha, the company made a profit, but by some tax saving mechanism, it has not paid the tax. It has rather saved 15,000. So I am very happy with this company. But let us come to the second year. The company has got a tax depreciation entirely. So there will not be any tax depreciation. The NPBT, net profit before tax, is 1 lakh. 30% thereon means the tax will be 30,000. So you will be left with 70,000 after the tax. All right. Now, this 30,000 will be charged as the tax expense for this year. So you would be having net profit after tax 20,000 in your books. Now, when you present these two periods financial statements to your investor, just look at what will go on in his mind. He will see 50,000. He knows that the tax rate is 30%, but he will be shocked to see that 30,000 expense suddenly comes in the second year. He will say, sir, first year you had a tax saving, you paid nil. So I appreciate that. Second year, I also understand that you may not have had a tax savings. So you should have paid 30%. Now you should have paid 15,000. Why are you paying 30,000? Why are you paying 60% tax rate? The answer is, he is not paying a 60% tax rate, my friend. This is not a tax saving that has happened. This is not a tax saving that has happened. Rather, this 15,000 liability, this 15,000 tax liability has been postponed to the next year. This 15,000 liability has been postponed to the next year by virtue of accelerated depreciation, and therefore 15,000 to the expense was there as it is. वो तो पहले भी था, that is there now also. But this 15,000 which you deferred on account of 100% depreciation, you postponed it. That is what has now come to haunt you. That is what has now come to visit you, to say hello to you. So therefore, tax for this 15,000 is fine. But this 15 is now getting added. Another clarification, the depreciation that you have claimed is 1 lakh over 2 years. Here also, my friend, you have claimed 1 lakh. So what is happening? In effect, over the 2 years, the depreciation that is claimed is equal. The depreciation that is claimed is equal. First year, you claimed entirely. Second year, not allowed. Whereas in the accounts, 50,000, 50,000. Over 2 years, the impact is the same. The fact is just that when we take a cutoff of the first year, I am getting this anomaly. I am getting a zero tax for the first year, whereas I am getting a 30,000 tax for the next year. So what the standard tells you, this is where the deferred tax comes. The standard tells you that you will have to create a deferred tax liability. Deferred means what? Deferred means postponed to the future. Deferred means postponed to the future. In this case, you are having a deferred tax liability of 15,000. You are having a deferred tax liability of 15,000. So you will create a deferred tax expense of 15,000. You will create a deferred tax expense of 15,000. So in the first year, now how the scenario will appear in accounts, let us see. In the first year, you will be having, just give me a minute, yeah. You will be having a deferred tax expense of 15,000, which represents the expense that you have postponed to the next year, which represents the expense that you have postponed to the next year. And this deferred tax expense gets a reversal in the next year. This deferred tax liability gets a reversal in the next year. Why difference, sir? Because the cause of the difference itself has met with a reversal. Reversal means what? They have become equal. The cause of the difference has been nullified. So therefore, the deferred tax liability has to be reversed. So therefore, this deferred tax expense creating a liability will now be reversed. This will now be reversed. So now for your financial statements presentation, 50,000 minus current tax expense. This is current tax. This is 0. This is 0. But there is a deferred tax liability of 15. So that you will subtract. So 50 minus 15, you will show a net profit after tax of 35,000 in your financials. In the next year, 50,000 minus 30,000 tax expense you will definitely show. But you will also show a reversal of 15,000. So 50 minus 30 minus of minus 15, that means plus 15. So that will again give you 35,000 rupees. So now the P&L that you present, oh, okay. 1 minute. Kaustubh is saying that there is a disturbance in the audio. Audio is getting muted automatically, then audible. Jay? Jay? Am I fine now? Just give me a confirmation, students. Jay, मेरा audio ठीक है? Jay? Since how long the problem is there, Kaustubh? Just give me a minute. Let me just check. Okay. Ambika has confirmed there is no problem in the audio. Thank you. Kaustubh, I hope you can hear me. All right. So I am all okay. Jay, ठीक है ना audio? अच्छा ठीक है. All right. Fine. So in this case, the deferred tax expense of 15,000, which is there in the first year, gets reversed in the second year. Thereby, it is now presenting a picture that 50,000 profit of the first year has a deferred tax liability of 15,000 being postponed to the next year, creating a net profit after tax of 35,000. Thereby, you can now check 30% is met. In this case now, 50,000 is the profit, 30,000 is your current tax expense, reversal is 15 of the liability. So net expense is therefore 15,000, 30,000 minus 15. So once again, when you take both of them together, the rate on this will be 30%. We have effectively demonstrated the use of this concept of deferred taxes. We have effectively demonstrated the use of this deferred taxes. Okay. Oh my God, Kaustubh has lost the audio for the past 20 to 25 minutes. Okay. Ambika, okay, the audio was clear for her. Divesh from Mumbai also said it is right, and Neha from Bangalore also said it is right. All right, then Kaustubh, I think you may have to see the feed again when it gets streamed on YouTube. All right, so this is what is going to be your answer. This is the reason for having deferred tax. The 2 periods as a whole, when we see 2 lakhs is your profit, 1 lakh is your depreciation, on that 30,000 is your expense. This is what is happening. But when I split it off, because of the periodicity concept where I have to do an annual profit and loss, when I do that, the figures tend to get distorted. To avoid that distortion, I am having a concept of deferred tax. Deferred tax is nothing but an outstanding expense that I have to recognize in my books if there is a liability. It is nothing but a prepaid expense that I have to recognize if there is an asset. That is the only concept. But of course, it is a simple way of telling, but there are various rules and regulations. There are various requirements that we will now have to fulfill. But I hope that the concept is clear. I hope that we have now understood what is deferred tax. With this background, let us look at the definition now. It is the amount of income taxes payable in the future in respect of temporary differences. In our example, the 15,000 represents a postponement of tax of the current year to the future. Therefore, it is amount of income tax payable in the future in respect of what? In respect of temporary differences. In respect of temporary differences or unused tax losses and unused tax credits. So today's discussion will be focused primarily on temporary differences. Why is it okay? Acha. Anjali is asking to please explain the example once again. All right. I will just explain it quickly so that it will be clear for everyone. Even for Kaustubh, I think he had what you can say a disturbance. So I will quickly explain this to you once again. Let us assume that the earnings before depreciation and tax is 1 lakh each for the 2 years. You had an item of property, plant and equipment. The useful life for accounts is 2 years. So the depreciation in financials is 50,000, 50,000. So therefore, the net profit before tax, the net profit before, let me rub all this so that we start with a clean slate. The net profit before tax is 50,000 each, 50. Now, if income tax and accounts, there was no difference. If income tax and accounts, there was no difference, on 50,000, your tax liability should have been 15,000. On 50, at the rate of 30%, your tax liability should have been 15,000, 50 into 30. And you should have recognized a tax expense of a profit after tax of 35,000. Profit after tax of 35. This was if everything was same as per income tax and accounts. But unfortunately, that is not the scenario. For tax, you are getting 100% deduction on the plant and equipment that you have purchased in the first year. So for tax purposes, I have prepared the statement here. 1 lakh is your earnings before tax. Depreciation is 1 lakh. So net profit before tax is 0. On that, the tax, obviously 30% of 0 would be 0. So what would you do? This is your tax expense. We have studied from the previous example. Tax expense in the previous case was 28 lakh 14. Here it is 0. So I will go very happy and put 0 tax expense in my year 1. And the profit that I will show in the accounts will be how much? It will be 50,000 rupees. 50,000 minus nil giving you 50,000. 50,000 minus 0 giving you 50,000. The next year, what happens? You are again having a profit before depreciation and taxes of 1 lakh. Now, for tax purposes, will you get a depreciation again? Answer is no. Why? You have already claimed 100%. So therefore, no depreciation. So therefore, your tax for the second year will be 30,000 rupees. Your tax for the second year will be 30,000 rupees. So your tax will come as 30,000 in your second year. This is the scenario. Now what you will be having, 50,000 is your net profit before tax minus 30,000, that will give you 20,000. Minus 30, that will give you 20. I'm not considering the deferred tax right now. All right. So there is income tax. There was a difference. So therefore, first year income tax was 0. Second year, it is 30,000. So your accounts will show the position as net profit before tax 50,000, tax 30, net profit after tax 20. Now, when the user of financial statements looks at both these figures, what he will see? In year 2, he will see 50,000 profit, 30,000 tax, 20,000. Corresponding year 1 figures, what he will see? Same profit, zero tax, net profit after tax 50. And there your investor will ask you a question. Sir, 50,000 was your profit in the first year also. You got a zero tax in that. But the tax rate was 30%. So now I understand you may have adopted a tax saving mechanism. But in the second year also the tax rate is 30. That means your expense should have been 15, correct? But it is not 15, it is 30,000. Sir, why it is 30,000? Why are you paying double the amount? That is what the investor will question you, and he has every right to question. So at that point of time, do you think you will present this computation of statement to your investor? Will you make it a public document, your computation of income, and give it to the investor? The answer is obviously no. This difference of 0 and 30,000 has arisen only on account of one thing, and that is on account of difference in the depreciations. On account of difference in the depreciation. Depreciation in the first case under accounts was equally allowed based on the useful life. So 50,000, 50,000 over 2 years, 1 lakh is your depreciation. For income tax also, over 2 years, depreciation is 1 lakh only. But first year, you are allowing a complete write-off of 100%. Why? Because the Act has given you that benefit. So first year, complete write-off of 100%, 1 lakh is the benefit. So the benefit of the next year, you are claiming it in the first year. Are you able to understand now? The depreciation that you would be getting for the second year, you are claiming it in the first year itself by accelerated depreciation. That means what? An expense of the next year you are claiming now. By claiming it now, you are reducing your taxable profit now. By reducing your taxable profit now, you are increasing the taxable profit of the future. You are increasing the taxable profit of the future. By reducing the taxable profit now, you are reducing the tax liability now. You are reducing the tax liability now. By reducing the tax liability now, you are postponing this to the next year when you will have increased profits. When you will have increased profits. Why increased profits? Because of next year's expense being claimed in the current year. Because of next year's expense being claimed in the current year. That means next year's expense means what? Tax depreciation. Are you 2 years life? Next year होना चाहिए था depreciation, not there. Why? Because you got a benefit of 100%. You claimed it now itself. So therefore, you have got the expense now. You lowered your profits now. You saved the tax technically. But in reality, you have borrowed from the next year. So next year, you will have to give the higher profit to the next year. So therefore, the tax saved now is going to be paid in the next year. That means current year ka jo tax hai, the tax of the current year, which should have been 15,000. What are you doing? You are doing nothing but postponing it to the next year. You are doing nothing but postponing it to the next year. So what the standard tells you, on account of this difference, this is a temporary difference. Why temporary difference? At the end of 2 years, everything is the same. At the end of 2 years, everything is the same. 1 lakh total depreciation, 1 lakh tax depreciation. Everything is same. The temporary difference is on account of cutoff in year 1. Year 1, there is a temporary difference. Therefore, the standard tells you, because of this cutoff date, you are now required to create what is known as a deferred tax liability. Why a liability? Because today you got an expense of the next year. Therefore, you have reduced your profits of the current year. But when you are getting the benefit from the next year in the form of enhanced depreciation, the profit of the next year will be higher. The profit of the next year will be higher. So therefore, the tax of the next year will be higher. Why it will be higher? Because current year you have claimed the expense. Therefore, it will be higher. In other words, you are postponing the tax liability from year 1 to year 2. You are shifting the burden of the tax. Because you are postponing, because you are deferring, it is known as deferred tax. Therefore, it becomes a deferred tax liability of 15,000 rupees. How to compute this 15,000? We will see. But concept is the same. Concept is the same. So 15,000 you are postponing. So what you will do in year 1? Year 1 current tax is 0, but you will make an allowance for deferred tax. You will make an expense for deferred tax. Entry will be profit and loss account debit to deferred tax liability, P&L to DTL, 15,000 rupees. This 15,000. What is this 15,000 actually? That also I can tell you. It is this 50,000 depreciation which you are claiming in the first year also. So 50,000 into 30%. The tax benefit on this expense that is there, you are claiming it here. So therefore, next year when you are not going to get this benefit, your profit will go up by 50,000. That has gone up, right? Here it is 50, here it is 1 lakh. It has gone up by 50,000. So therefore, you will be having a deferred tax liability of 15,000. Next year, your current tax liability is 30, but you already have a deferred tax liability of 15. Now what you will do? You will write it back. Why you will write it back? Because there is a reversal. Why there is a reversal? Because the reason for the temporary differences have now been met. The reason for the temporary differences have now ceased to exist. Now everything is same as before. Therefore, you will have to reverse the deferred tax liability. Entry for reversal will be what? Deferred tax liability to P&L, 15,000. Deferred tax liability to P&L, 15,000. So you will reverse it. So what will be your net tax expense for the first year? Current tax 0 plus deferred tax 15. So your NPAT will be not 50, but it will be 35,000. It will be 35,000. And in the second year, 50,000, current tax 30, but a reversal of DTL of 15,000, a reversal of DTL of 15. So 30 minus 15, again your expense will be 15,000. So your net profit after tax will be 35,000. And therefore you can tell your investor, look, first year I have a deferred tax expense. I have created a DTL. So that is 15,000 rupees. Next year I have a current tax expense of 30, but I have a reversal of DTL which I created in the first year. Therefore, 30 minus 15, 15,000 is your net tax expense, which is again 30% of 50,000, which is again 30% of 50,000. So you are happy at giving a correct disclosure. Your investor is happy at looking at the figures not being distorted. Your investor is happy looking at the figures not being distorted. So this temporary difference is the main reason for the deferred tax arising. This is the main reason for the deferred tax arising. All right. So I hope that you have now understood the problem, and I have to proceed further because we have a lot to cover. But if there is any doubt, please write. I will try to address it immediately. Okay, that means after the concepts are proceeded further. But we will have these problems visiting again, Anjali. So don't worry. There is a better problem that you will be having, which covers a longer time span, which I intend to do now. So there the concept will again get clearer. Okay, so if you have understood, good. If you have not understood, just give it some time. You will be understanding it soon. All right. So with this background, let us now proceed to the definition of deferred tax. We have seen temporary difference into tax rate. What is temporary difference? How to calculate? We will see that in a while from now. Okay, so this is an introduction to deferred tax. Yeah, Anjali, okay. So Kaustubh has understood, not a problem. Anjali, now please you also pay attention to question 2. Question 2 and 3 are, question 2 is somewhat similar to the first example that is there on your study material. Okay. Somewhat similar. I won't say it is exactly the same. Question 3 is not there in your study module. It is just, I have just put it for a better understanding. Question 2, question 3, both are the examples. Question 2 is similar to the example that I have done. All right. Question 3 is the inverse of question 2. Let us look at question 2. TriStar Limited acquires a machine for 8 lakhs and decides to depreciate it straight line over its useful life of 5 years. So 8 lakhs divided by 5, the depreciation will be 1,60,000 per annum. Okay. Please pay attention. It's a very nice question, a very elementary question. All right. Okay, Anjali. Thank you. Next. Income tax legislation allows depreciating machines straight line over 4 years. All right. So 8 lakh by 4, tax depreciation will be 2 lakhs per year. All right. In years 1 to 5, TriStar Limited's taxable income before the tax depreciation expense is rupees 4 lakhs and the tax rate is 30%. Show the TriStar Limited's current tax expense, deferred tax expense, deferred tax asset or liability, and the net profit in the years 1 to 5. So I hope you have the sheet with you. Let me stop the sharing. I'll be a little bit fast as far as the calculations are concerned, but I will be generous when I'm doing the conceptual explanation. First one, first item, carrying amount and depreciation. Carrying amount and depreciation. This is as per accounts. This is as per accounts. Now, see, this is just a conceptual understanding. How the standard envisages, I'm not yet come to that. I will be discussing that once I complete these two standards. But first, let us get the concept right. Let us get the concept right. All right. So now I'm having year 1, year 2. Useful life for accounts is 5 years, right? Useful life for accounts is 5 years. Year 3, year 4, year 5. Now, these are your 5 years. Now, opening carrying amount. Opening carrying amount. This is the amount of the asset, that is rupees 8 lakhs. Less depreciation. What is your depreciation rate? 1/5. Useful life of 5 years. So 1/5 will be your depreciation. So 1,60,000 each. 1,60,000 each. Okay. So this will be your depreciation per year. All right. Now, closing carrying amount. Closing carrying amount. Carrying amount is nothing but WDV. Carrying amount is nothing but WDV. So this will be 6,40,000 for the first year, which will be opening of second year. Closing will be 4,80,000, which will be opening of the third year. This will be 4,80,000 minus 1,60,000, 3,20,000. 3,20,000 opening, 1,60,000 closing, 1,60,000 opening, closing will be 0. So this is what is going to be the way your asset will look like over 5 years. Starting with 8 lakhs, depreciate 1,60,000 each year. So therefore, at the end, the carrying amount will be 0. At the end, the carrying amount will be 0. So how will my P&L look like? Net profit. How will my P&L look like? This is step 2. Year 1, 2, 3, 4, 5, same years. Now, what is your profit before tax depreciation, before depreciation expense, that is 4 lakh rupees. So therefore, earnings before depreciation and tax, excluding tax impact, excluding the tax impact. Okay. So earnings before depreciation and tax, this is 4 lakhs each. This is 4 lakhs. 4 lakhs. And lastly, 4 lakhs. All right. Now, what is your depreciation? 1 lakh 60, book depreciation. Okay, this is accounts. So book depreciation is how much? 1 lakh 60,000, 1 lakh 60,000, 1 lakh 60,000, 1 lakh 60,000, 1 lakh 60,000. All right. Now, what is your net profit before tax? 2 lakh 40. 2 lakh 40. So far, it is manageable. Now, if everything was same in income tax and accounts, if everything was same, then this is NPBT, tax at the rate of 30% should be. Look at the words I am saying, tax should be. It's not, because there is a tax impact, but I am saying if everything was same, tax should have been 30%, that is 72,000 each. 72,000 each. If everything was same as per tax and accounts, tax should have been 72,000. Tax should have been 72,000. So therefore, net profit after tax should be, it won't, but should be, idealistic scenario, it should be 1 lakh 68,000. It should be 1 lakh 68,000. It should be 1 lakh 68,000. All right. This should have been your net profit. When you give this picture to your investors, they will be very happy. Why? Because uniformity is maintained. See, a very hypothetical example this is. All right. 5 years, you won't have the same profit. In fact, 2 years also, you won't have the same profit. But for us to understand, yeah. So now your investor will be very happy looking at this, right? Accounting has happened properly. My company is paying its taxes. Everything is fine. So therefore, no need to panic. But now what happens? There is a tax element. There is a tax element. So third working will be tax depreciation. Tax depreciation. Now, carrying amount is how much? 8 lakhs. 8 lakhs, sorry. Carrying amount is 8 lakhs less tax depreciation. What is the tax depreciation? SLM basis over 4 years. So 1/4. So this will be 2 lakhs. So 8 minus 2, 6 lakhs. This is carrying amount. This is carrying amount. 8 minus 2, 6 lakhs. 6 lakhs will come as opening. Again, 2 lakhs will be deducted as depreciation. 4 lakhs will be closing tax WDV, carrying amount for tax purposes. 4 lakhs, 4 lakhs, 2 lakhs, 2 lakhs. Now, 2 lakhs depreciation for the 4th year is 2 lakhs. This is 0. So 0, 0, 0 in the last year. I hope you have understood the tax depreciation also. I hope you have understood the tax depreciation also. Each year, 2 lakh rupees will be your depreciation. Each year, 2 lakh rupees will be your depreciation. Now comes the interesting part, which is your actual net profit, which will be now your current tax expense followed by net profit. Now this is done. I hope this is done. It's a very elementary calculation. So I will rub this off. Pardon me for the speed, but I have a lot to cover. Okay. And it is manageable. So I will hurry up and we can discuss many more things. Okay. Now, current tax expense. Fourth working will be current tax expense. Now pay attention. Here, my earnings before depreciation and tax is 4 lakhs each year. 4 lakhs each year. Correct? Now, will you subtract accounting depreciation? Answer is no. You will subtract tax depreciation, which is 2 lakhs, less tax depreciation. First year, 2 lakhs. Second year, 2 lakhs. Third year, also 2 lakhs. Fourth year, also 2 lakhs. Fifth year, nothing. Why? Because the asset has been fully written over 4 years. So therefore, net profit before tax, that is your taxable income. That is your taxable income is how much? 4 lakhs minus 2 lakhs, 2 lakhs, 2 lakhs, 2 lakhs, 2 lakhs, and finally it will be 4 lakhs. Finally, it will be 4 lakhs. All right. So this is what is fine. This is what is your taxable income. Therefore, tax at the rate of 30%. This is actual tax. This is actual. This is an idealistic figure. It is not so. Actual tax will be 2 lakhs into 30%, 60,000, 60,000, 60,000, 60,000, and here it will be 1,20,000. Here it will be 1,20,000. So my actual tax expense will be 60,000 for each of the years, and in the last year it will be double, 1,20,000. Why? Because no depreciation. 4 lakhs is your profit. 4 lakhs into 30%, 1,20,000. Now the fifth working will be what? The net profit after accounting for current tax expense. What is your current tax expense? This figure, 60,000. This will be recorded now. So that is your tax expense. So I will modify this as under. All right. Rest all is the same. Rest all is the same. This will be the change. Current tax expense. Because this is your actual tax liability, and current tax definition tells me tax payable for the current year. So the amount will be how much? 60,000, 60,000, 60,000, 60,000, and last year it will be 1,20,000. Last year it will be 1,20,000. Now the question comes, sir, first year my profit is 1,80,000. Second year my profit is 1,80,000. Third year my profit is 1,80,000. Fourth year my profit is 1,80,000. But suddenly in the fifth year my profit is 1,20,000. 2,40,000 minus 1,20,000. 1,20,000 becomes your net profit after tax. Current tax expense, make the changes in the words, and this is net profit after tax. Now when your investors will look at these figures, they will be puzzled. They will say, everything was same in year 1, you gave me an NPAT of 1,80,000. 2, 3, 4, you gave me an NPAT of 1,80,000. But suddenly in year 5, you are giving me 1,20,000. How is that possible? So will you give them computation of incomes of all the periods? And the answer is no, 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 you will not do that. Let us understand now why this difference is coming. Let us understand now why this difference is coming. Let us check. This difference is coming because of difference in taxes. Okay. Your tax amount in the earlier, I have rubbed it off. It was 72,000, right? It was 72,000. As against this, compare your actual tax. Therefore, difference in taxes only. First year, 72 minus 60, 12,000. Second year, 12,000. Third year, 12,000. Fourth year, 12,000. Fifth year, 72 minus 12. That gives you a negative of 48,000. That gives you a negative of 48,000. What does this mean? From the fifth year, you have taken the tax benefit and paid less taxes in year 1, paid less taxes in year 2, paid less taxes in year 3 and 4. As a result, the cumulative deferment has accumulated to 48,000, and that is reversing in the fifth year. That is reversing in the fifth year. Now, why is it reversing in the fifth year? It is reversing in the fifth year only because your depreciation. Look, depreciation is completing the full 5-year period. That means 8 lakh is charged here, and here also 8 lakh is charged. Here also 8 lakh is charged. So therefore, the depreciation is accounted for completely. The reversal of the taxes also will take place. So what the standard tells, this 12,000, current tax is 60, but it should have been 72,000. This additional 12,000 is a postponement of your tax. It is a postponement of your tax. You have postponed this tax to year 5. You have postponed 12,000 to year 5 in each of the 4 years. And in year 5, that sudden expense is coming and hitting you in the form of 1,20,000 current expense. That sudden hit is coming to you in the 4th year in the form of 1,20,000 current tax expense. All right. So therefore, the standard tells, don't mislead your investors by saying that you have saved tax. You have not saved tax, my friend. You have postponed the tax. You have postponed the tax. Because you have postponed the tax, you have to record a liability today. What will be the liability? 12,000 each year. So each year you will pass the entry P&L account debit to deferred tax liability. Sir, amount, how will we come to know? Very simple. Tax depreciation is 2 lakhs. Book depreciation is 1,60,000. Each year you are claiming 40,000 rupees extra expense. From which year? Beta, you are claiming it from the 5th year. So 2 lakhs minus 1,60,000. Each year you are claiming 40,000 extra. So 40,000 into 30% tax rate. That gives you 12,000 rupees. That gives you 12,000 rupees, which is your rate. So therefore, P&L to DTL, every year you will pass this entry for 12,000 rupees. Thereby what will happen? Current tax 60,000, deferred tax 12,000. You will ultimately show the expense of 72,000. Sir, at the end of year 4, what will happen? Year 5 will come. In year 5, your depreciation is met. In year 5, the reversal would take place. So in year 5, DTL to P&L, you would record a deferred tax credit. You would record a deferred tax credit of 48,000. This you compare with current tax expense of 1,20,000. 1,20,000 minus 48, that will again give you 72,000 rupees. That will again give you 72,000 rupees. So each year, what are you doing? You are debiting your profit and loss with 72,000. What will be the breakup of 72,000? 60,000 current tax expense plus 12,000 deferred tax. 60 plus 12, 60 plus 12, 60 plus 12, 60 plus 12. And in the fifth year, it will be a reversal of the deferred tax. Why do I have a reversal? Because my depreciation is now fully exhausted under tax also, under accounts also. Therefore, 1,20,000 minus 48, that will also be 72,000. That will also be 72,000. So in your actual accounts, how will my profit and loss look like? How will my profit and loss look like? It will look something like this. Okay. I hope you are all following. मेरे राइट में ये ठीक है. ओके 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 ओके. इज इट ओके अभी? ठीक है. ऑल राइट. ओके. ऑल राइट. तो now what we will do is, let us record the actual P&L. Okay, actual P&L. Actual P&L. How does it look? It looks something like this. Earnings before depreciation and tax, 4 lakhs, 4 lakhs, 4 lakhs, 4 lakhs, 4 lakhs. All right. Now, earnings before depreciation and tax is 4 lakhs minus accounting depreciation. What is your accounting depreciation? 1,60,000. Because I am preparing my books as per Ind AS. As per Ind AS, my depreciation is 1,60,000. So therefore, 1,60,000. So 4 lakh minus 1,60,000, 2,40,000. 2,40,000, 2,40,000, 2,40,000, 2,40,000. This is what? This is net profit before tax less current tax expense. Your current tax expense comes straight away from the current tax working which we had already prepared. So 60,000, 60,000, 60,000, 60,000, and in the fifth year, tax profit was 4 lakhs, no depreciation. So 4 lakhs into 30%, 1,20,000. 4 lakhs into 30%, 1,20,000. Less deferred tax expense. First year, tax depreciation was 2 lakhs. Tax depreciation was 2 lakhs. Book depreciation was 1,60,000. You have claimed more in tax. How are you claiming more? From the fifth year. Since you are claiming more depreciation in tax, you will be showing lesser profits for tax purposes. Since you are showing lesser profits, you will be paying lesser tax now. But because you are paying lesser tax now, what you will be doing? You will be paying more taxes in the future, which is already visible. 60,000 was there for each year, and in the fifth year it became how much? In the fifth year it became 1,20,000. So therefore it's visible now. I am paying more in the future by taking the expense of the future right now, 40,000 each. So therefore I have to create a deferred tax expense of 12,000. I will be creating a deferred tax expense of 12,000. So this 12,000 I will create. Fifth year, no creation of deferred tax expense. Why? Because the reversal has happened now. All my tax depreciation and my book depreciation is same. Now there is no question of any further deferred tax. There will be add deferred tax reversal. Add deferred tax reversal, which is 48,000, which is 48,000. So now when I do the totaling, what I will get? 2,40,000 minus current tax 1,80,000 minus 12, 1,68,000. 1,68,000. 1,68,000. 1,68,000. And finally 2,40,000 minus 1,20,000, that gives you 1,20,000 plus 48, 1,68,000. This is what is going to be your final profit and loss that you will present in accordance with this standard. In accordance with this standard. Have you understood? Yes. I hope you guys have understood. This is just a build up on the example of 2 years that I did. This is a build up on the example of 2 years that I did. This is covering a longer time span. This is covering a longer time span. So each year, now I can tell my investors, look, 2,40,000 is NPBT. My tax expense is 72,000. Tax rate is 30%. So 2,40,000 into 30%, 72,000. 30%, 30%, 30%. 1,20,000 minus 48 is also 72, which is 30% of 2,40,000. This is the intention. I do not want to distort my figures on account of certain differences that arise between my tax treatments and my accounting treatments. So therefore, the concept of deferred taxes. All right. Anybody has any doubts? Please ask. Anybody has any doubts? Please ask. If no, then we shall proceed further. If no, then we shall proceed further. I was a bit fast because the computations were repetitive. Please confirm. Yes, sir. Understood. Okay. Ambika has confirmed that she has understood. All right. And I hope Neha, Kaustubh, Divesh, all those who are, these are the ones who are interacting with me. Okay. So that is why I take their names. Okay. So this is done. And this covers your basic concept about deferred tax. This covers your basic concept about deferred tax. I will now proceed to the next. Okay, Ambika has confirmed. Who was that girl? Anjali from Punjab. Yes, I hope you have understood. Kaustubh also hope you have understood. Yes, all right. Next. The next question I will leave with you for homework. Okay, Kaustubh has understood. Preeti from Dubai has understood, and Ambika also said crystal clear. Uma has understood. Yes, thank you. Now I leave you with question 3. I leave you with question 3 for homework. Mellon Limited obtained a bank loan from a scheduled bank, the interest on which amounted to 1 lakh rupees per annum. As per section 43B of the Indian Income Tax Act, okay, interest on the bank loan will be deductible for tax purposes only when actually paid. Due to cash flow problems, the company could not pay the interest accrued for years 1 to 3. It settled all the interest dues in year 4. That means year 4, it has paid year 1 also, 2 also, 3 also, 4 also. All the 4 dues it has settled. The borrowing was repaid at the end of year 4. All right. EBIT of the company for each of the years 1 to 4 amounts to rupees 10 lakhs. Okay. Assuming all other components forming part of the EBIT are accounted identically for tax purposes as for financial accounts, Show Melon Limited's current tax expense, deferred tax expense, asset or liability, and the net profit after tax in years 1 to 5. Tax rate is not given, you can assume it to be 30%. Tax rate is not given, you can assume it to be 30%. Now, my friends, I want you to do this question for homework. I will tell you the concept. This is exactly opposite of this question. Year 1, you will have finance cost for accounts. Year 2, you will have finance cost for accounts. Year 3, you will have finance cost for accounts. Year 4 also, you will have finance cost for accounts. But for tax purposes, how are you getting the deduction? You will be getting the deduction only when it is paid. Only when it is paid. Is it paid in year 1? No. So interest for tax purposes for year 1 will be 0. Interest for tax purposes for year 2, that will also be 0. Interest for tax purposes for year 3, that will also be 0. Interest for tax purposes for year 4 will be 1 lakh of year 1 plus 1 lakh of year 2 plus 1 lakh of year 3 plus 1 lakh of year 4. Together it will be 4 lakh rupees. So in year 4, you will ultimately get the entire deduction. You will ultimately get. So in this case, reversal is happening in the 4th year. Each year 1 lakh, and for tax, it is being reversed in year 4. In this problem, what will happen? Expenses will be live? Acha, acha. Okay, okay. So there was a technical snag. So now I will explain what is to be done. Interest for years 1, 2, 3 will come in the books, but it will not be tax deductible. So therefore, you will pay more tax in years 1, 2, 3. In year 4, you will have only 1 year's interest expense, but for tax purposes, all the 4 years interest expense will come because you are paying it in year 4. So in effect, you are claiming greater expense in year 4. Therefore, in years 1, 2, 3, that burden of the additional tax you are saving in the future. So you are creating a deferred tax asset in years 1, 2, 3. In year 4, you will write off that deferred tax asset. In years 1, 2, 3, you will create. In year 4, you will write off the deferred tax asset. So I want you to try question number 3 by yourself. Please understand, do it, try it out. I want you to try it out for homework. You will be able to get it because then you will understand how the things actually flow. But again, I repeat, this is the concept, but how the standard envisages, we will now see it. This is the actual concept of a deferred tax asset or a liability because of a temporary difference. There is a temporary difference. In year 1, there is a temporary, in question number 2, there was a temporary difference. Question number 3, there is a temporary difference. First case, it was depreciation. Now it is interest paid on cash basis and interest charged on accrual basis. So I want you to try question number 3. That will make me very happy if you have been able to do it successfully. All right. So question number 3, all yours for homework. Let us now proceed to deferred tax recognition, measurement, and presentation. But I will give a small break of 3 minutes. Okay, just 3 minutes because there was a disruption. We are now entering the main topic. So I want us to be focused on this topic. So take a quick 3-minute break and then we shall resume. Okay. Jay? Jay? ब्रेक 3 मिनट का सिर्फ, ओनली 3 मिनट्स, ठीक है? ओके। Okay. All right, students. Let us now come to what the standard talks about. I have explained the concept of deferred tax. I have explained what happens in deferred tax, and now we shall come back to what Ind AS talks about. The problems that we have seen so far on depreciation, that problem mainly was in accordance with the P&L based approach, the profit based approach. What I did, I compared the profits. Profit was higher in the tax in one case, in the accounts in another case. I ascertained the reasons for such difference in profitability. It was on account of higher depreciation in tax, lower depreciation in accounts, or finance cost disallowed in tax in the first 3 years, allowed later on. So this is a profit and loss based approach. The reason I had to do this approach was because you actually understand what deferred tax is all about. If I directly jump into Ind AS 12, and start doing the balance sheet based approach, we cannot really, appreciate why this deferred tax concept came into picture. Now we shall look at what Ind AS 12 says. Ind AS 12 adopts a balance sheet based approach. Ind AS 12 adopts a balance sheet based approach. You see, I told you, each standard is an improvisation over the earlier. So now I will not look at the profit and loss account figures at all. I will not prepare a working like how I prepared now. This working was to make you people understand. But for the purposes of Ind AS 12, my guiding lamp will be the balance sheet. My guiding lamp will be the balance sheet. So in all the deferred tax computation, that is recognition, measurement and presentation, is the major part of the standard. That is a 10-step process. That is a 10-step process. Step number 1, compute the carrying amounts of the assets and the liabilities. No P&L now, only the balance sheet. Very easy it is. It is possible to do. I want all of us to be alert now, because now the Ind AS 12 process will commence as far as deferred tax is concerned. Impact of the balance sheet based approach we have seen on the P&L. But for your answers, you will have to give the balance sheet based approach, because that is what the standard tells. So compute the carrying amounts, compute the tax base. Tax base is coming the second time, my friends. Tax base is coming the second time. Compute temporary differences. What is temporary difference? It is the difference between carrying amount and the tax base. Sir, you have not told us what is tax base. That is what is going to be our entire discussion now. Only on what is tax base of an asset and a liability. These differences that we have, they can be classified into taxable temporary difference or deductible temporary difference. Again, new terms, but we will learn what they are. Step 5, identify the exceptions. And then we are having step 6, assess the deductible temporary differences, tax losses and credits, determine the tax rate, calculate and recognize deferred tax, account for it, and offsetting the deferred tax assets and liabilities, comply with other requirements of Ind AS. This is the 10-step process. Sir, 10 steps, it is so long. It is not long, all right. In fact, the major step that is there is step number 2. That is the major step that is there. After step number 2, step number 3 is nothing but step 1 minus step 2. After 2, the immediate major step is step number 4. You are given some exceptions where DTL should not be recognized or DTA should not be recognized. Some limited exceptions. So they are limited. Generally, you will be having other, your general is wider. So that happens most of the cases. Identify exceptions, look at whether the transaction falls in that exception criteria. That is not a major aspect. Then assess deductible temporary differences. We will see this. Determine the tax rate is a small item. Calculate and recognize deferred tax. That is nothing but temporary difference multiplied by the tax rate. That is nothing but temporary difference multiplied by the tax rate. Accounting for deferred tax. How to account? I gave a brief snapshot. P&L account debit to deferred tax liability or deferred tax asset to P&L. And in the very first slide, I told you that record the transactions and events where they have been originally recorded. That means if the item is a P&L item, tax effect will go in the P&L. If it is an OCI item, it will go in OCI. If it is a statement of changes in equity item, it will go in statement of changes in equity. So accounting deals with that. And can you offset DTAs and DTLs and other requirements means disclosures. So this is step number 10. So let us now come to step number 1. Very simple. What is carrying amount? Sir, what is carrying amount? All of us know what is carrying amount. It is nothing but the ledger balance. It is nothing but the ledger balance. What is your ledger balance? Balance of the account, that is the asset or the liability that is recognized in the balance sheet after necessary adjustments like depreciation or impairment, etc. So I think I have mentioned the wrong page number. It's not page number 5.23. It is some other page number. Please have a look. Okay, it is chapter number 10. That much I remember. So anyways, this is a small question on carrying amount. Entity A had acquired an item of plant and machinery for rupees 1 lakh on 1st April X1. It depreciated this item at 10% per annum on SLM basis. For the year ended 31st March X2, it provides depreciation of rupees 10,000. What should be the carrying amount of this plant and machinery as on 31st March X2? Very simple. Acquired 1 lakh, depreciation 10,000, carrying amount is 1 lakh minus 10,000, that is 90,000. Which standard am I following? I am following Ind AS 16 when I measure my assets using the cost model at the cost less accumulated depreciation less accumulated impairment. If you are following revaluation model, that is also permitted under Ind AS 16. So even in the case of revaluation, you will use the revalued amount less accumulated depreciation, less accumulated impairment. Whatever is done, the ledger balance and your accounts have to be maintained as per impairment, as per Ind AS. That will be your carrying amount. That balance of the asset or the liability will be your amount, will be your carrying amount. Let us now come to the next step. The next step is compute the tax base. The next step is compute the tax base. What is your tax base? Now this is important. Please pay attention. Please pay attention. Tax base is a simple term. It is the amount attributed to an asset or liability for tax purposes. That means, let us assume a hypothetical scenario wherein you not only prepare Ind AS balance sheet, you also prepare a tax balance sheet. In reality, we don't. But let us assume you prepare a tax balance sheet. In the tax balance sheet, what do? You record all incomes, all expenses in accordance with what? You record all incomes, all expenses in accordance with the tax laws. So the carrying amount of the assets in that balance sheet, which balance sheet? The tax balance sheet. The carrying amount of the liabilities in which balance sheet? In the tax balance sheet. That will become the tax base of an asset or a liability. So therefore, tax base of an asset is amount attributable to an asset. Tax base of a liability is an amount attributable to that liability for tax purposes. The standard further defines what is the tax base of an asset. What is a tax base of an asset? If the benefits that flow from that asset are taxable, if the benefits that flow from the asset are taxable, then the tax base will be the amount that is deductible for tax purposes against any taxable economic benefits that will flow to an entity when it recovers the carrying amount of the asset. There are a lot of examples. Let us not panic by looking at this definition. I will be solving conceptually the examples with you. When I solve the examples, you will appreciate then that this definition fits into the definition of tax base of an asset. In case of the economic benefits are not taxable, then the tax base is equal to the carrying amount of the asset. This is as per the standard. If it is a liability, the tax base will be carrying amount minus the amount deductible for tax purposes in respect of that liability in the future periods, if any. When you do these two deductions, you subtract the second from the first, what you get is tax base of the liability. Sir, theory, we don't understand, sir. You have to give some examples. I am now picking up your examples from the study material. Okay, so now, just a minute, 1 minute, please. Let us come to the next slide. Yeah. Now we are having lot of examples. Yeah, here the page number is correct. Tax base of an asset if economic benefits are taxable. Okay, I think I have stapled it wrongly. Yeah. Tax base of asset if economic benefits are taxable. First one, entity A had acquired an asset for rupees 1 lakh on 1st April 20x1. It depreciated this item. At 10% per annum. It depreciated this item at 10% per annum on SLM basis. As per tax laws, this item of plant and machinery has to be depreciated at 70%, has to be depreciated at 30% per annum on WDV basis. So this is your question. It is picked up straight from your study module. So now let us look at this problem. Henceforth, have the modules open in front of you. You can make notes adjacent to the answers, adjacent to the examples in the study module, or you can make it separately. So I'm stopping the sharing and you have the examples in front of you. Yeah. So now what is the example? There is an item of property, plant and equipment, financial statements. There is an item of PP. What is the cost? Cost of this asset is 1 lakh rupees. Cost of this asset is 1 lakh rupees, and the accounting depreciation, it depreciated this item at 10% per annum. So less depreciation at 10% is 10,000. This is my depreciation for Ind AS. So what is this 90,000? This becomes my carrying amount. This 90,000 becomes my carrying amount. Now what will happen in the tax balance sheet that you prepare? I told you tax base is the amount attributable to that asset for tax purposes. So as if we are preparing a tax balance sheet. So in your tax records, the PPE will have the same cost, no doubt. So 1 lakh rupees will be your cost. But what is the depreciation that is allowed? Less depreciation at the rate of 30%, 30,000. So therefore 1 lakh minus 30,000, 70,000. What is this 70,000? This will become your WDV under the tax laws. Now I will use this asset. I will use this asset in the future. By using this asset, what I can do? I can either produce goods and get sales, or I can sell this asset itself. Get the benefits. If I sell this asset or sell the output of this asset, what I will get? I will get a taxable benefit. This could be in the form of output, or this could be in the form of sale of this item of machinery. It could be anything. Now, the fact is, what important thing is that benefit should be taxable. So it could be this benefit. Now tell me, for income tax purposes, in the future, what will be the deduction that you will get? You will not get deduction of 90,000. No. Income tax has already given you a deduction of 30. So therefore, in the future, what is the additional deduction you can claim? Additional deduction you can claim is only 70,000 rupees. Look at the words. Tax base of an asset is the amount deductible in the future against the taxable benefits that will flow from the asset. So in the future, how much deduction I can claim? I can claim only 70,000. Whereas your carrying amount is how much? Your carrying amount is 90,000. So this gives rise to a difference. If I was doing AS22, the two examples that we just saw, what we would compare? Depreciation of 10,000 in books vis-a-vis depreciation of 30,000 for tax purposes. That is your concept for AS22. Now please shut that concept. Now we are in Ind AS 12. The impact will be the same. See, here I have charged more depreciation in tax records as per AS 22. Whereas here in Ind AS 12, 70,000 is my tax WDV. In the future, I cannot deduct 90. I can only deduct 70,000. So therefore what? I can only deduct 70 means what? I can deduct 20,000 less. I will be deducting 20,000 lower than accounts. I will be deducting 20,000 lower than accounts. That means in the future, suppose I sell this asset for 1,50,000. Hypothetical, I sell this asset for 1,50,000. I can deduct 90 because that is my carrying amount as per the books. So 1,50,000 minus 90. In the future, I will be showing a profit of 60,000 in the books. But for tax purposes, what will you do? 1,50,000 minus 70,000 only you can deduct. You can deduct only 70. Why? Because you already got the excess claim of 30,000 depreciation. So 1,50,000 minus 70. In the future, you will be assessed to tax on the profit of 80,000. So what is the additional tax you are paying? 20,000 on 20,000 rupees. Additional tax you are paying on 20,000 rupees. What is this 20,000 rupees? This is nothing but the additional depreciation benefit that you have already received under income tax. The additional depreciation benefit that you have already seen. So it is like looking at the same profit-based concept, but now with the lens of a balance sheet, approach, In future, how much is deductible? In future, if lower is deductible, naturally profit will be higher. So when profit will be higher, in future, you will pay more tax. That is what the standard tells you. So therefore, what will be the tax base of the asset in this case? In this case, it will be 1 lakh minus 30,000. That is 70,000 rupees. The amount that is deductible in the future. For tax purposes. So this is done. Let us now come to the next example. Yeah. Entity A has inventory with a carrying amount of rupees 1 lakh. Entity A has inventory with a carrying amount of 1 lakh as at the reporting date. It recovers the value of inventory through sale in a subsequent reporting period. Okay, simple. When you purchased this inventory, let us assume that this is a trading entity. You are buying and selling. So when you purchased, you pass the entry, purchases account debit to cash, bank or creditors, whatever, 1 lakh rupees. Now, this inventory, how will you account for in your tax? You will also account for it at 1 lakh rupees. There is no option only for you. So, purchases account debit 1 lakh rupees to cash bank creditors 1 lakh. Now, this inventory is there in your stock. So here you will be having inventory carrying amount is 1 lakh. It is there in your stock. For tax purposes also, my friend, this inventory is there at a value of rupees 1 lakh. Now in the future, when you sell this inventory, let us assume for 1,25,000, you will write sale value 1,25,000 minus cost of goods sold 1 lakh rupees. So your book profit will be 25,000. For tax purposes, what you will do? Very much the same. Sales will be the same, whether it is accounts or the tax. So 1,25,000 is the future taxable benefits that you will get from the sale of this inventory. What is the sale of this inventory? What is the amount deductible? Amount deductible is minus cost of goods sold. What is amount deductible? Amount deductible is 1 lakh rupees. So therefore, carrying amount for tax for Ind AS, that means the carrying amount as defined in this standard is 1 lakh. The carrying amount for tax purposes, which is nothing but the tax base of this inventory, that is also 1 lakh rupees. So here carrying amount is 1 lakh and 1 lakh is also your tax base. 1 lakh is also your tax base. By virtue of this, will there be any difference in profits? Answer is no. Whatever was your purchase amount for tax, for accounts, the same purchase value you have taken for tax. So is this creating a difference? Answer is it's not creating a difference because amount is the same. So therefore, there won't be any deferred tax implication as far as just the purchase and inventory recording is concerned. Yes, as far as just this pure transaction is concerned, there won't be difference. Carrying amount 1 lakh, tax base 1 lakh, difference between both of them is 0. So this is the second example that we have done. Next, entity A has acquired an item of asset for rupees 1 lakh for production of certain items to be sold by the entity. Okay, so it has acquired some items for production. It has acquired an asset for production, a PP. It is deductible equally over 2 years in the books of accounts. In Income Tax Act, 75,000 is deductible in year 1. Balance is deductible in year 2. Okay. So we are having again the same concept of depreciation. In the first example, it was for 1 year. Now in the next example, it is going to be there for both the years. So now, property, plant and equipment. Now, in this case, year 1, year 2. Now, cost when you purchased it for 1 lakh. Less what is your depreciation? 50,000 for financial statements. So in the first year, you will be having a carrying amount of 50,000. In the second year, you will be having a carrying amount of nil. But now for tax purposes, the same PP, when you purchased it, the cost was 1 lakh. That will be same because it is a transaction. You will record it for 1 lakh. But what is the depreciation permitted? Less depreciation. First year itself, you will get a depreciation of 75,000. So therefore, your carrying amount for tax purposes would be 25,000. Carrying amount for tax purposes is what? Amount attributable to the asset for tax purposes. That is nothing but your tax base. Now look at both these things. First scenario, there is a carrying amount of 50. So if I sell this asset for 1,30,000, for example, so therefore against 1,30,000 sale of asset, my cost is 50. So I will be having a gain of 80. But against the same sale value in the year 1,30,000, my tax base is 25. So deductible amount also is only 25,000. So 1,30,000 minus 25, you will in fact be subjected to a taxable profit of 1,05,000. You will in fact be subject to a taxable profit of 1,05,000. So therefore, first year, my carrying amount is 50, whereas my tax base is 25. Amount deductible against profits. Amount that is deductible against future taxable profits for tax purposes is what is the meaning of your tax base. I hope that you are able to follow, you are able to understand. These are simple examples, but the same concept what we have seen in the first 2 long questions that we did today, the same effects will come when we look at it from the lens of a balance sheet. Let us now proceed to the next example. All right. Let us now proceed to the next example. Interest receivable has a carrying amount of rupees 100, right? as a carrying amount of rupees 100, the related interest revenue will be recorded on a cash basis. Related interest revenue will be recorded on a cash basis. All right. Now let us look at this question. In financial statements, you have already passed the entry interest receivable account debit to interest. How much? 100 rupees. You have already passed this entry interest receivable account debit to interest, and this interest you transfer to P&L. Interest income account debit to P&L 100. This is what you have passed. So what is the carrying amount of your interest? The carrying amount of your interest receivable is rupees 100. Carrying amount of interest receivable is rupees 100. As against that, in the cash records, my friends, in the cash records, will you record the interest receivable? And the answer is no. Why? Because you will record only when you actually receive the interest. They have given that it is taxed on cash basis. Accrued is happening, so therefore cash would be received in the future years. So what would be the balance of interest receivable? Interest receivable would have a nil balance. Interest receivable would have a nil balance. In the future, when you receive cash received towards interest, when you receive the money of 100, that point, what will be deductible from that interest? Deductible amount will be 0. Deductible amount will be 0. So therefore, your tax base of interest receivable is 0. Your tax base of interest receivable is 0. It is not accounted in tax records. It is not recorded. So therefore, in future, when you receive, you will be paying a tax on 100. You will be paying a tax on 100. This is also how you will do this problem. Interest receivable check 100. As against that, what is deductible in the future? Nothing is deductible because you have not accounted for interest receivable. There won't be an interest receivable account. You will just have the entry cash account debit to interest income as far as tax is concerned. No interest receivable, therefore interest receivable would be 0. Tax base of interest receivable is 0 in the case of this example. In the case of this example. Is it okay? So with this, let us close the session for today and have a happy Diwali. Happy Dhanteras, happy Diwali, and we meet with fresh mindset on Monday morning, and we complete the standard on Monday. We have lots to do. Please revise what we have done. If possible, I'm just giving you some more homework. If possible, try to solve, at least read through the examples of the institute as far as assets are concerned, tax base of assets are concerned. I have introduced how to do it. So I request you to at least look into the examples. You may be able to do it, you may not be able to do it, but I want you to look so that you will be more comfortable on Monday morning. Okay, so let us meet on Monday. Have a safe Diwali, stay safe. See you guys on Monday. Okay.